It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader in less than 5 minutes per week. The video newsletter is brought to you by TradingTips.com.
Welcome to this video newsletter on ROC, rate of change, an important indicator of market momentum. Without further ado, let's get started. What is ROC? Well, it measures the rate of a stock's change in price and predicts future price movements. This is a simple and effective technical indicator that is also widely overlooked. Now, thanks to the fact that we're all living in the digital age, you'll never need to calculate ROC on your own, but it is helpful to understand how it is calculated. The formula for ROC is the most recent closing price, symbolized by X, minus the closing price a certain number of days ago, symbolized by Y, divided by Y. For example, if you wanted to do a 10-day ROC, then you would take the stock's most recent closing price, subtract its closing price from 10 days earlier, and then divide the result by that second closing price. If the stock's most recent closing price and its closing price from a given number of days ago are the same, then its ROC will be 0, or at equilibrium. So what value should you use for Y? The general rule of thumb is that short-term traders should use the stock's closing price from 10 to 50 days earlier. Longer-term oriented investors might want to use 26 or 52 weeks. It should be noted that the default value on Yahoo Finance is 12 days. Here I've pasted an example of a stock with big ROC moves, along with a red line showing the ROC equilibrium. Can you see where the big changes in ROC took place? Now take a look. You can see that at point A, the stock's ROC turned positive, rising up through equilibrium, even though the stock's price was actually down for the day. This was a bullish sign that predicted the stock's massive bull run over the next couple of weeks. Then at point B, the stock was once again rather steady, but its ROC went down, predicting the short-term losses that came over the next couple of days. Finally, let's take a look at point C. This is where the stock's ROC headed down and fell below equilibrium. And just look at what happened to the stock's price from there. Here's another example. See if you can spot the most significant ROC movements. Here I've made 4 key points. If you look closely, you'll notice that the points marked B, C, and D all came when the ROC changed directions, even as the stock's price was relatively unchanged. Yet in all 3 cases, a new pattern developed that could have made traders a lot of short-term money. And in the case of point A, the stock was up that day, but with the ROC changing directions and coming up through the equilibrium line, it signaled that the stock was about to explode, and it did. To recap, ROC is a momentum indicator that can offer confirmation of an existing trend or make predictions as to where a stock is headed. Although we only had time to look at one time frame per chart in this episode, it's a good idea to consult multiple time spans for added confirmation. And as with all technical indicators, ROC is strongest when it is confirmed by other technical signs, such as MACD, MFI, RSI, stochastics, etc., all of which are covered in earlier TradingTips.com episodes. We hope you've enjoyed this video newsletter. Thank you and good trading.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. Do you want to view more Trading Tips videos? Visit TradingTips.com. Sign up for our free video newsletters. Become a successful trader by visiting TradingTips.com.